share. Can you all see the slide?
Yeah.
Okay, terrific. Again, like I did last month, I'm not an attorney, CPA or CFP, so don't invest or take any action based solely on what I present. This is for educational and entertainment purposes only. So follow advice of those people who you trust. And for those of you who don't know, but I think most of you all on here have been a part of this group for a while, so welcome. That we've been around now going on, we just started our 4th year, and I promise to never make you part of some national guru's marketing funnel. That's one promise I always try to keep. Last month, I did talk a lot about economic conditions and what some of the impacts were and what are some of the things you should be looking for if you're going to invest in multifamily. And this slide came from that, but the rest of the presentation is going to be on what's actually happening in April and May so far in the multifamily space. But I wanted to leave this slide up here just to let you know what's underlying all of this is the National Federation of Independent Businesses did a survey of small businesses, and it said, how long would you be able to operate your business under current economic conditions? And if you look here, these 2 lines account for 50% of everyone who responded to the survey said they can only last no more than 2 months of being shut down. And we've hit that 2-month mark and gone a little beyond. And then another 20-some%. So we're talking now over 70% of small businesses. We're in the red zone for all of them now. We've already heard on the news here locally and nationally about businesses that won't be coming back. And there's a lot more who are defying local government orders for opening because they're in this boat now where if I don't open now, I'm not going to make it. So I'm not taking political sides one way or the other, but this is the reality based on this survey. And it's what's driving the 36+ million people who've had to file for unemployment. So, and it's that unemployment that's causing a lot of the uncertainty because of this virus. And that goes with rent collections, as Robin was talking about. You hear different things if you're listening to the news. You're hearing 35% of renters didn't pay their rent. Or when I talk to a bunch of folks around the country who have properties, like Robin said here, she's collecting her rent. So, what's the real story? And I think the truth is probably somewhere in the middle. But this came from the apartment list group, and this was a survey. And you can see here that in April, this is the percentage of people who paid their rent, didn't pay the rent, or did some kind of a partial payment. And in May, those numbers have gotten a little bit worse. But usually by the end of April, at least for the April numbers here, most of them wound up paying. But in May right now, it looks bad, but we're only halfway through May. So we'll see what happens there. But that's according to apartment list. When I go to the rent payment tracker, I forgot who this was from, where they collected data from 11.4 million apartment units across the country. We're seeing that in 2019, these were the April and May collection percentages. And in 2020, we're not that far off. In fact, May's collections through the early part of May almost mirror the collections for May of last year. So I'm not sure where the real story is, but I noticed that a lot of people I talk to say they're collecting rents at about the same pace that they always have and at the same percentages. So for the most part, we're not seeing a lot of people not paying their rent, apparently. And I think a lot of that is helped by the government stimulus. People are using some of that money and their unemployment. By stimulus, I don't just mean the $1,200 check everyone got, but if they're on unemployment, they're getting, at least the $600 federal pandemic unemployment, plus whatever the state pays per week. And that may be what's helping them continue to pay the rent and at least buy food. So, although with all the long food lines we've seen, I'm not sure about that even. But people are paying rent, at least as of right now. So, that's a good sign. Another good sign of multifamily is because of this pandemic, people aren't willing to go out and look at a lot of different places. They're choosing to stay and re-up where they're at. as opposed to trying to find someplace else to move to. And nationwide, that percentage we're seeing when it's usually 50% or less, it's a almost 58% retention rate for tenants deciding to stay instead of move. And you can see that based on the class of property here. Class A retention is at 50%, Class B, and then Class C retention is almost 60%. And there's reasons for each of these. I mean, Class A, with all the new luxury apartments that have been built in the last couple of years, people have an opportunity to go and move and get concessions that they wouldn't necessarily normally get today, and or they can find someplace a little cheaper that's still a Class A property. So they have the ability to move better than maybe, say, someone in the Class C area. So, but that's what we're seeing. Retention rates are up, rents are being collected. So those are two good stories. But what we're also seeing as far as rent growth, it's been relatively flat, and it's still growing. It's at a 3% growth rate, but it's been fairly flat now for better part of a year, year and a half. So if you're looking to underwrite at a 4 or 5% rent growth rate, you may want to reconsider. 3% is where it's at, and there's just a slight downward trend through the first quarter of 2020. We'll see if that downward trend continues for a while, or if it then winds its way working back up to some extent. We're seeing a lot of property owners are not raising rents at all, and they're planning not to raise rents for the next 12 months so that they can retain the people they have and make it easier for people to pay, as opposed to trying to raise rents and hoping to get more money. They're putting off their growth plans for another year. Along with that is coming some concessions that we haven't seen in the past. Usually the Class C properties, which is this gray line, offers the most concessions, but we've seen, because of some of the issues with retention and the high cost of rents in the Class A properties now have to offer more inducements to get potential tenants to come rent from them. So we need to keep an eye on this, but I guess the good story is we're still looking at concessions under 5%. So when you look at the last crisis, concessions went up, 8, 9, 10%. So we're not anywhere near there right now, and time will tell, and we'll have to keep an eye on this and see what's happening going forward. With all that said, though, rental revenue change, we're seeing over the last almost 8, 9 years, rental revenue has grown at between 4 and 5%, and then today, when you're looking at, well, at least as of April of this year, revenue growth is down to 2.73%, and that's the lowest since February of 2011. So again, we're not getting a lot of the increased profitability out of these properties that we would like to see, and I think we're going to see this number go down a little more because of the virus for at least the next few months. Concessions being given. Yeah, you can either ask questions now and cut in and ask verbally, or both. The kinds of concessions that people are giving is maybe they don't have a security deposit, or they're getting 13 or 14 months of rent for the cost of 12. It depends on the property and the owner and what they're comfortable with. Maybe you get half off your first month's rent if you sign up for a 12-month lease, or your first month's rent free, or something to that effect. So it can be as creative as you want it to be, as long as it works for you and it works for you financially. Sales, though, and this is the big thing we've seen, and it's strictly due to the virus. If you look all the way over here on the far right-hand side, this is the first 3 months of 2020. In January, sales for multifamily properties was just over $15 billion. And that's a good hefty number. Not as good as some other peak quarters or months that's illustrated in this graph. In February, as we started to hear things more about the virus and people started to see a little bit of fear, we were at 13.4 or just over 13 billion. In March, it went down to $9.5 billion. And you can bet in April and May, we're going to see those numbers go way down, unfortunately. That's partly due to a lot of the sellers are pulling their properties off the market. I saw a bunch of properties get pulled where the brokers wound up sending out email notices saying, hey, this property is now off the market. We'll reconsider, when we have more clarity in the market and with what's happening with the virus. Also, bank underwriting requirements have gotten a lot stricter, making it harder for people to get the returns that they need for their investors. So there's fewer people chasing the deals. That's not to say that there aren't deals out there to have, but you don't see any blood in the water, so to speak, just yet, due to forbearance, loan forbearance, and/or renter forbearance. A lot of these issues that might force properties to be sold at discounted prices they're kicking that can down the road a little bit. So the question is, when will that happen, and how bad or will it be bad when that time comes? Another thing we're also seeing, though, is interest rates relative to the Federal Reserve rates. The Federal Reserve took rates down to almost functionally zero, but the interest rates really have sort of flatlined. They haven't continued to go all the way down with the 10-year Treasury. In fact, the multifamily cap rate rose 477 basis points in the first quarter of 2020, for interest rates above that particular yield. So banks have decided that it's a little too risky for them. They're not going to follow the normal trend where, there was a closer spread here in 2018, and they're not going to continue to maintain that limited spread between the 10-year Treasury and what they're going to charge their customers. So it's
hey, Dennis,
yeah.
Dennis, real quick, I noticed Robin asked a question back when you were talking about concessions, and she was asking if you could give an example of the types of concessions that are being given.
Yeah, as I mentioned, it could be any number of things. One, it could be some kind of free rent. It could be no security deposit. It could be, I'll give you 13 or 14 month lease for 12 months, the cost of 12 months. Whatever works for you and makes sense for you financially. That is also an inducement. Maybe you give away, I don't know, some kind of a gift to someone for renting from you. I'm not sure what it would be. It depends on your property, but some kind of enticement.
So real quick, do you think just with the changes of the underwriting process, I know we talked about master lease options.
Yeah.
Do you think that is going to be a technique that's going to kind of come into play heavily in the near future?
Well, I know I've already started exploring that with a couple of properties I've been talking to, and and there are a number of other people I've talked to who are starting to do the same thing, because I think it makes sense, because it gets everyone by the the uncertainty of the virus and what's going to happen and the reopening of the economy. But a lot of the sellers, they're not sufficiently motivated yet to necessarily consider more creative ways to sell, unless they're really in dire straits, and for the most part they're not there yet.
Well, and if the feds are putting the multifamily loans in forbearance, and then you put everybody's rent in forbearance, it kind of just freezes everything and shifts it over. Right. And some people believe we're going to kind of have this V, kind of everything's going to bounce back when it reopens. So yeah, it's difficult to find someone that's motivated in that situation.
Yeah, and it's hard to know what's going to happen economically, because on the one hand, you've got some elements of the government telling you it's going to be a V shape. You got a lot of the Wall Street people are hoping it's a V shape recovery. You've got the Federal Reserve Chairman telling you, no, it's not going to be V shape. It's going to be a long, drawn out process. And then you hear everything in between. So we don't know. So how do you hedge that bet, right? And if you're going to still try to buy multifamily, you're going to have to agree with the seller to hedge it together.
Yeah.
Or it just might not work. And right now, I'm not seeing a lot of sellers who are in that position where they're still looking at trying to sell for the lowest cap rate possible, like you're seeing here. And get as much money as they can, because those are the promises they made to their investors, 1, 2, 3 years ago. And their operating agreement says, these are the things I have to try to deliver. So this is what I'm going to try to deliver. Cap rates have ticked up just a little bit this year, but not significantly. So we want to keep an eye on that. And then the average price of things, though, and this is where I'm saying the sellers aren't feeling a lot of pain, because even though the rate of growth in pricing has gone up, it's gone up a little less, but it's still going up. In the major markets, Washington, D.C., San Francisco, L.A., New York, and other places like that, they're seeing still a significant growth in pricing. Every other city, call it secondary or small primary markets, they're still seeing growth in their, per door unit, per unit costs, but the growth is starting to slow a little bit. So, we got to continue to keep our eye on this as well. We're in a pandemic, we're in an economic shutdown, but as far as multifamily is concerned, prices are still going up.
Hey, real quick, Beth just emailed and said that she got knocked out and couldn't get back into the email. Excuse me, couldn't get back into onto the meeting.
Okay, hang on.
So I don't know what that means.
Yeah, I know she got kicked off. Let me see here. And I don't see her in the queue to get back in either. So, okay.
Okay. All right, I'm going to mute myself.
Not a problem. Everyone still see the loan maturities now?
Yeah.
Okay.
Yes.
This is where the potential opportunity is, I think. This is when we're going to start to see, or how we're going to be the reason behind starting to see more motivated sellers. In this year alone, we're going to see $73 billion in current multifamily loans come due. And if the economic conditions and the banks and the interest rates don't change to go back to the way they were, a lot of these people who are going to have to sell or refi are going to have trouble doing that. And that's when we're potentially going to start to see the opportunity to buy some good quality deals. In 2021, that number goes up to $88 billion when you factor in loans from banks, from agency loans like Freddie and Fannie, commercial mortgage-backed securities, and life insurance companies who also lend. But for the next 2 or 3 years, 4 years probably, through 2024, there's going to be a lot of opportunity as a lot of these loans come due. Depending on how the economy is at that time, there's going to potentially be an opportunity to buy. So this is the near-term opportunity here, the $73 billion, and next year, and it all depends on whether we get something close to that V-shaped recovery, or if it's going to be a multi-year, long drawn-out thing, whether this will be a real no-kidding opportunity, or whether it's just going to be hit or miss. So COVID is having an impact, but nothing bad yet. There's not any blood in the water. Sellers are still looking for top dollar, and there's still some people out there who are trying to buy, but those who are trying to buy sensible and are factoring in, this 12 to 18 months of principal and interest, plus 12 months reserves for taxes and insurance. When you factor all that in, it starts to become a little harder to make your cash on cash returns. So there's a real disconnect there that the virus is causing, a real buffer between what the sellers are looking for and what the buyers are going to be able to buy for. So overall, the virus is going to dictate the pace of recovery, and we'll see which way it goes. So that's all I have here on this. Any questions on